ทางด้านการเงินจะนำเสนอตัวเลขผลการดำเนินงานปี2024และท่านใดมีคำถามสามารถพิมพ์คำถามเข้ามาในระบบได้เลยนะคะค่ะขอเชิญคุณคารินค่ะ
Thank you, Sean. So we will do our presentation in two halves. In the first half, I will talk about the industry structure, and in the second half, Gautam will take you through the financials of the company. So if you look at the performance of China, you can see clearly that in 2024, China really performed very well. If you look at iron ore, it was up by 4.8%, up to 1.24 billion metric tons. If you look at coal imports, it was at 543 million metric tons, up by 14.4%. China's steel production was at 1,005 million metric tons, down by 1.7% compared to last year. But steel exports was up at 111.1 million metric tons, up by 22%. Steel consumption was down by 4.4%. So overall, you can see clearly that China has outperformed the market expectations. If you look at the total steel consumption, and if you look at an 8-year average, it's at 993.13 million metric tons per annum during the period 2016 to 2023. If you take the 5-year average, beginning in 2019 up to 2023, the average works out to 1,040 million metric tons. And if you look at what is the estimate for this year, for last year, 1038, that is 1,038 million metric tons. So compared to the 8-year average, it's up by 3.71%, but compared to the last 5-year average, it's down by 1%. So China is still functioning very well and still consuming a lot of steel. If you look at the feeling that there is an impact from the property sector and there's a slowdown, yes, there is some sort of slowing down, but it's not as significant as I've shown you in the previous slide. Now, the government of China has been focusing on alternate steel consumptions. So if you look at that, look at exports as an example. If you look at the month of December, it was at 9.7 million metric tons, and that was a 26% year-over-year increase. If you look at the steel consumption in northern China, it normally slows down during the harsh winter. If you look at the domestic demand, it's expected to fall by further 1% in 2025. If you look at the sectors that are growing, it's in auto, energy, and shipbuilding. If you look at the first quarter of last year, the freight market was shocked with the speed at which the market went up, and this was mainly because China was importing a lot more iron ore, and the rainy season in Brazil was much drier. It was not very wet, and therefore iron ore could be exported in a big way. Then if you look at the steel exports out of China, it was massive, and as a result, the Handy, Supra, and Ultra ships benefited the most from that, and it led to a very strong Pacific market. If you look at what drives purchases or imports into China, you will see that it is mainly driven by pricing. If prices are strong, imports are weak. If prices are weak, imports into China are very strong. And this has been the way it has been since 2020. So if you look at 2020, commodity prices have driven up imports. And at that time in 2020, 9% increase took place in the imports because of record low prices, because of the shutdown of the rest of the world due to COVID. If you look at 2022, volumes slumped because Russia invaded Ukraine and all commodity prices went up dramatically. But if you look at September 2023 to September 2024, prices dropped by about almost 20%. And as a result, imports into China hit a record of 4.6 billion metric tons in 2023. If you then see in value terms, imports into China reached $2.59 trillion in 2024, up 1% year over year. If you look at total iron ore imports in 2024, they exceeded expectations at 1,238.2 million metric tons. If you look at steel exports in December 2024, they were 9.7 million metric tons, up by 26%. And if you look at the whole year, it was at 111.1 million metric tons, up 22%. And if you look at the government stimulus for the 50 whitelisted property firms, it is one of the reasons why the property sector, though it's declining, is declining at a very slow level. If you look at the overall market for dry bulk and focus on row 3 from the bottom, you can see how the ton-mile demand has been varying. For example, if you look at 2021, it grew by 3.73%. If you look at 2022, it was down by 0.91%. If you look at 2023, it was up by a staggering 5.76%. And 2024 is estimated at 5.18%. So very strong growth in 2023 and 2024. Now, if you look at 2021, with a growth rate of 3.73%, we made $137 million net profit during that year. And most dry bulk ship owners made very good money during that year. But if you look at 2022, when demand actually came down by 0.91%, we actually made $139 million, $2 million more profit in 2022 than in 2021. And the reason why both 2021 and 2022 were very profitable is mainly because of the inefficiency that crept into the market at that time due to the fallout from COVID. So a lot of ships got delayed because of that. In 2023, despite the fact that the markets went up by a staggering 5.76%, and if 2024 by 5.18%, we made only $20 million net profit in 2023, and we doubled that to $41 million in 2024. So you can see clearly that inefficiency in shipping is quite important. And if it is there, then even if demand is negative, as you see in 2022, you still make a lot of money. And in 2025, the expected demand is at 1.12%. And if you look at the last row, it tells you how tonnage has grown. So you can see tonnage growth in 2029 and 2020 at about 4%. And then you can see it dropping down to about the 3% level, which is where it is at today. If you look at minor bulks and just focus on that and look at 2021, it grew by 5.98%. If you look at 2022, it grew by 0.9%. If you look at 2023, the growth rate was 3.86%. And look at 2024, the estimate is at 4.89%. And look at 2025, it's at 2.31%. Against that, if you look at the growth in tonnage, it has been averaging around 3% per annum all the way between 2019 to 2023. In 2024, it's expected to be at 4.2%. And in 2025, it's expected to grow by 4.3%. If you look at the track record for Clarksons in terms of what they have been forecasting, you can see that most forecasting in shipping is very difficult to get accurately done. Similarly, for fleet growth, this is where I think Clarksons got even more surprised. If you look at what they were expecting for 2024 at the start of the year before, in January 2023, it was almost 0% growth. And yet, by the end of December 2024, they're forecasting that the overall fleet will go by 3.1%, and the smaller sector, that is our sector, will go by 4.2%. And the same thing for 2025. So I would take all forecasts in shipping with a pinch of salt. If you look at the share of commodities that each type of ship carries, you can see Capesizes are focusing their energies on carrying iron ore 77% of the time, coal 15% of the time, and one minor bulk, which is from Guinea to China. And this is your raw material for making aluminium. And that's 8%. If you look at Panamaxes, it's 8% on iron ore, 58% on coal, 21% on grain, and 12% on minor bulk. Again, the same minor bulk, aluminium. If you look at Supras, it's 4% on iron ore, 21% on coal, 15% on grains, and 16% on minor bulk. Similarly, if you look at Handysize, it's even more concentrated in minor bulk, 68%. If you look at one thing, and just to explain to you how well we fared in the year 2024 was mainly because of the steel exports from China. So if you look at the steels, which is on the chart on the left, if you look at the second row from the top, it's steels. It's showing you that we were carrying 14 points. We spent 14.7% of all our time on our fleets on carriage of steel. And if you look at the world fleet, it was only spending 4.4%. So that means we were in excess, we carried in excess of 10.3% of steel as compared to the rest of the world. So 2.5 times as strong as the world was in steel, we were carrying. So this explains why we did fare very well in 2024. One of the strong points was the steel exports from China. If you look at the overall fleet growth, you can see that in the whole world now, we have got at the start of this year, we've got 14,233 ships in the dry bulk sector. Average age is 12.7 years of age. The total deadweight is at 1 billion tons, a little bit more than 1 billion tons. And the average deadweight per ship is 72,303. If you look at the total growth in the last column, and the last row on the lower part of the chart, you can see that we added 32.51 million metric tons overall into the dry bulk sector. Of that, roughly half of that was from the smaller sizes and half of that was from the bigger sizes. If you look at the order book at the start of this year was 109.53 million metric tons, or 10.64% of the existing world fleet. And if you compare that with the 20-year-old fleet as of the 1st of January, it's 9.8. So really a replacement of the older ships. If you look at the past, you can see that the growth rate of the order book was very, very high in comparison to the A, the 20-year-old fleet, and B, the total change in the fleet that was taking place. If you look at the same thing in terms of consolidated numbers, 2003 to 2009, which was the big bull run, you can see, for example, from the third row from the bottom, you can see that the order book to fleet ratio at the start of each year in that period of time was 26%. If you look at 2010 to 2020, in those 11 years, it was at 32.21% at the start of each year. If you come to 2021, 2022, it was averaging 6.48% at the start of each year. If you come to 2023, 2024, those 2 years, it was averaging 7.89% at the start of each year. And at the start of 2025, it has gone up to 10.64%. If you look at the annual average of 20-year-olds at the start of each of the years, in the 2003 to 2009 period, it was averaging almost 17%. In the 2010 to 2020 period, it was almost 30%. In 2021, 2022, it was 6.76%, actually higher for the first time than the order book to fleet ratio. And if you look at the start of 2023, 2024, it was 88.28%, again, higher than the order book to fleet ratio. If you look at the average for 2025, it's at 9.8%, barely just marginally lower than the order book to fleet ratio. So once again, it appears to us that the order book is the replacement of the older ships. If you look at average speed, that has been going down consistently, except for Capesizes in 2024. And the reason for that, as I said, is that Brazil had a very dry winter in the December month, December, Jan, Feb month, and therefore they could export a lot of iron ore into China. But look at any other sector and you'll see that the speed was lower and has been lower every single year that we put up for you. If you look at the BDI and compare it with the previous 3 years, you can see that the current BDI of last year average was 27% higher than 2023. It was 9% lower than 2022 and 40% below 2021. If you then look at the new orders placed in millions of deadweight tons in 2024 compared to the prior 3 years, you can see that the 2024 number was 10.31% less than that ordered in 2023. It was 28% above what was ordered in 2022, and it was minus 9% compared to the amount ordered in 2021. And the reasons for that are quite simple. We've explained this to you before, but there is a fourth category now that we've added, which is that the main engine availability is now a significant constraint. Like the yards have more capacity, they've started opening up more of the mothballed yards which were there in China, but the main engine developers and makers have not increased their capacity in line with the increased capacity by the shipyards, and therefore we feel this will now strangle the order book further. So what are the key industry takeaways? One is, if you look at the economic situation, you can see both the IMF and the OECD, both of them are forecasting that the world GDP growth rates will grow by between 3.2 and 3.3% every year in 2025 and in 2026. If you look at the Chinese growth rate, it's going to be about 5% for both these years, in each of those 2 years. If you look at China's fixed asset investments, it was 3% in 2023, it improved 3.2% in 2024. And I think that you will find that the Chinese government will continue to expand fixed asset investments in 2025 and in 2026. If you look at the fleet growth, it was around 3.1% in 2023. It's remained unchanged at 3.1% in 2024. In 2025, it's supposed to be at 2.9%. But net supply will be further reduced due to slower speeds by complying with EEXI. And I have a few slides later on to show you how quickly that will happen. If you look at the forward order book to fleet ratio at 10.64% as of 1st of this year, it is marginally higher than the 20-year-old fleet at the start of this year at 9.8%. And then, of course, there are disruptions. The major disruption which we will not put down on this slide for you is President Donald Trump. Every day he comes up with a new decree, and it looks like the world will either come to an end or it will flourish very well. So basically, forecasting is now even more difficult with Trump in charge. But what we see is that overall supply and demand balance is continuing to improve. So what has been our strategy? So if you look at us, we've been slowly expanding our fleet. And you can see that we have gone from 36 ships in December 2020 to 40 ships by the end of last year. And if you look at it in overall terms, we are roughly the same size per ship. And therefore, we've added more capacity. We are at one point almost 8 million deadweight tons. If you look at the benchmark ships and see the benchmark ship for the handy-size at 38,000 and look at our average size of our fleet at 32,000, you can see that we are at a 20% discount in deadweight ton terms to the handy-size index ship. And yet, if you look at our overall performance, it was only 7.5% below the handy-size index. If you look at the Supramax index, you see that we were 3.11% above that index. If you look at our forward 4-year book, you can see that we, at the start of 2025, we have a forward book of almost $218 million. If you see how we've done our fleet renewal so far in 2024, you can see that we have sold 4 ships. If you look at the last 2 rows, you can see that the speed of these ships the economical speed is all at 12 knots. And if you see the consumption, it varies between 18 tons, 17 tons at the lowest in the ships that are sold and 26 at the highest. If you look at the ships that we have bought in replacement, you can see that we've been doing at 12 knots, somewhere between 13 tons and 17 tons. So you can see that we are much more economical on the newer ships. And the newer ships, secondly, are also a little larger than the ships that we have sold. And we hope to continue this exercise in the future. Now, Gautam will take you through the financials of the company.
Thank you, Khalid. So here are the highlights for 2024. For the year 2024, we reported a net profit of about 1468 million or USD 41.31 million or about 0.94 per share. Our EBITDA for the year came in at about 2913 million or 82.6 million US. We paid 3 interim dividends through the year, totaling 30 satang. We successfully acquired about 58 million shares as part of a voluntary tender offer for BL Enterprise at 1.24 baht per share from 12th November to December 18th. Last year, accounting for about 4.9% of the total shares of that company. So we own about, actually as of now, we own about 20%. So we've made a disclosure to the stock exchange about that. In terms of financing, we signed 4 loan agreements last year, totaling 70.58 million. 2 agreements with Exim Bank of Thailand, while there was another agreement with EO Bank of Japan and Sino Bank of Taiwan. And then we also became the first Asian shipping company to issue sustainability-linked bonds in the amount of about 1360 million. That's equivalent to 40 million US. And one series was 5 years and the other one was 10 years. So in terms of acquisition of vessels, as Khalid just mentioned, we acquired 5 second-hand bulk carriers. We also signed 4 shipbuilding contracts for Ultramax vessels at Taizu Sanfu Ship Engineering Company Limited for delivery starting in Q1 2026. And we also sold 2 handy-sized bulk carriers and 1 Supramax bulk carrier. In terms of contracts, we have 5 ships on long-term time charters at fixed rates, and we have 17 ships on long-term time charter contracts at rates linked to the underlying index for vessels of that size. The highlights for Q4 for the 4th quarter. So our net profit for the quarter was 249 million baht or USD 7.33 million or 16 satang. EBITDA came in at 663 million baht or 19.5 US million. We also paid the dividend number 3, interim dividend number 3 of 10 satang on 6 December. Already talked about the other thing. So in terms of deliveries, we took delivery of the 2015 built handy-sized Napa Nari and Nisa Nari during the quarter. So here's an overview of the ships that we acquired, signed MOAs for, and we sold. So some key figures for 2024 compared to 2023. So our revenues for full year 2024 came in at 177.8 million, up from 149.2 million at the end of 2023. Net profit for the year was 41.3 million US compared to 20.4 million US in 2023. Our earnings per share was 94 satang compared to 46 satang in 2023. As a result of this, the return on equity was much more. It was 7.42% compared to 3.99% in the previous year. The net debt to equity ratio at the end of the year was 0.37 compared to 0.31. And we ended the year with 40 ships compared to 38 at the end of 2023. So we look at this on a quarterly basis. So Q4, the total revenues were slightly up from the figure in Q3. So it came in at 44.2 million compared to 42.8 million in Q3. Net profit was somewhat similar. It was 7.3 million in Q4 compared to 8.2 million in Q3. Earnings per share 0.16 compared to 0.18, and return on equity 7.42 compared to 8.1. So over here we look at the on the top left we look at the time charter rate per day for each of the last 5 quarters, and you'll see that rates have remained fairly stable. So in the last quarter in Q4, the average TC rate per ship per day in our fleet was 12,177. EBITDA has remained fairly stable as well, so 20 million for the 4th quarter. We continue to pay stable dividends, I would say. So the dividends we paid in Q4 were 156 million baht, the interim dividend number 3 that I just mentioned. And our cash balance remained quite healthy at the end of the year. It was at 64 million US. So this is our statement of financial position at the end of 2024 compared to the end of 2023. So shareholders' equity was up to 496 million compared to 475. These are all US million figures compared to 475 million at the end of 2023. Total loans and debentures was up to 249 million compared to 214 million. And this is primarily because of the bond we issued in the 4th quarter. We have been acquisitive through the year, and so therefore our total vessels and equipment figure it moved up from 609 million at the end of 2023 to 657 million at the end of 2024, and cash has remained fairly stable. So here's a a little bit more granular breakdown of cash movement in 2024. So we began the year with 68 million of cash. We generated 94 million of cash from operations. We had capex of 128 million. We had 32 million of cash from sales of ships. We had the finance costs of 16 million. We had loans of 64, loan repayments and prepayments of 68 million. And the bond, 40 million of proceeds from the bond. And dividends, we paid 18 million. And we ended the year with 64 million. So here are the figures in Q4, the cash movement in Q4. So the only thing, again, to highlight perhaps is so the cash we received from the bond of 40 million. And capex, of course, we took delivery of 2 ships. So that's 46 million. Most of these acquisitions were actually done with cash on balance sheet to quite an extent. So we have, during the year, as I mentioned, we took several loans. We started the year with 214 million of loans. We drew down loans from BBL, that's Bangkok Bank, Singapore, IFC, Credit Agricole, Exim Bank of Thailand, and Sinopac. We paid back and prepaid loans of totaling 68 million. So total loans, excluding the bond, of course, is 209 million. And we also have quite a substantive amount of undrawn loan facilities available to us, so from IFC and from Exim Bank of Thailand, so totaling 127 million. So here is a breakdown of our operating expenses per ship per day, average operating expenses per ship per day in 2024 compared to 2023. So overall, the figures in 2024 were slightly higher than 2023, and this is mainly because of slightly higher crew costs. Otherwise, I would say the costs have actually, if you look at stores and expenses, stores and spares, this actually came down. Dry dock special survey was up. Otherwise, expenses have remained fairly stable. So these are the figures on a quarterly basis. Over here, we compare our average operating expenses to the average operating expenses for the industry as a whole. So for the year 2024, the average operating expenses for the industry as a whole came in at 5,114, and for us it was about 4,600. So about in excess of $500 per day lower than the average operating expense for the industry. So every $100 in savings over here translates to about $1 million on the bottom line at the end of the year. So here's the dry dock schedule for our fleet in 2025. So we have 2 ships going to dry dock in Q1, 8 in Q2, 2 in Q3, and 6 in Q4. So over here, we compare our G&A and OPEX to 3 other listed peers in the Supramax, Ultramax sector. And you'll see that our operating expenses plus G&A is the lowest among our peers. The total is 5,470. Well, this is for Q3 2024 data. We don't have data for Q4. These companies haven't reported that as yet. But if you see for Q3, our overall OPEX plus G&A was lower than our peers. And then if you look at the EBITDA per ship for Q3, we were the second highest. Same thing for the last 12 months EBITDA per ship. We were also the second highest among our peers. So here, this is the debt maturity profile. So you see our the maturities are fairly even over the coming period, over the coming years. There's no major debt maturities in the next 3-4 years. Over here, we show you our net debt and net debt to equity ratio. So you'll see that in 2014, our net debt to equity ratio was 0.7. Total debt was 345. And this went up as we took delivery of a number of new building ships that we had ordered. When it peaked in 2017 at 412 million, and the net debt to equity ratio was 1.1. Since then, it's been declining as we've been repaying loans. Came down to 146 million net debt in 2023, and since we've been acquiring a few ships, it's gone up to 185. So over here we show you the average OPEX and TC rates. So look at the top line. So this over here shows you the average age of ships in our fleet starting from 2005. So you'll see that in the period from 2005 until about 2011, our fleet was fairly elderly. Thereafter, we started to take delivery of our ships that we had ordered, new ships that we had ordered, and the average age started to come down. It was at its lowest level in 2016, and since then it moved up. But we've arrested that increase to an extent by acquiring younger ships over the last 2-3 years. Also, you see this red line over here shows you the average size of ships in our fleet. And you'll see the average size of ships in our fleet in 2005 was about 25,000 deadweight, and it remained that way until about 2011, whereafter it started to move up as we started to take delivery of the larger Supramax, Ultramax ships that we ordered. And so now the average, so we've had a mix of Ultramax, Supramax, and Handysize. So the average size of ships in our fleet reflects that. So it's remained fairly stable since about 2016-17, about 44,000 deadweight. This line over here shows you the average time charter rate per ship per day. So from 2005 until about 2008, China was growing very fast. There was the dry bulk markets experienced this sort of super cycle. But after there were a number of ships that were on the order book. Those were delivered from 2008-9 until about 2016, and that pressured freight rates, causing them to decline. The bottom of the market was about 2015-16. Since then, the supply pressures have abated, and so you've seen an increase in freight rates on the back of better demand-supply fundamentals. This line over here, the bottom line, it shows you the average operating expenses per ship per day for us, and this has remained fairly stable, of course, moving up in line with inflation. So over here we show you our dividends. So our policy is to pay not less than 25% of our net profit as dividends. We've generally exceeded that, as you will see over the years. So even in most recent years, we've paid well in excess of 25% of our net profit as dividend. So here are some financial highlights. I'm not going to go through these numbers. This is a reference slide. You can go look at them later on. So we did our IPO in 1993, and if you were an investor in our IPO and if you held on to our shares until today, you will have enjoyed a 15.63% IRR on your initial investment in the IPO in 1993. This is basically the stock price on 14th February. So we compare ourselves to other dry bulk listed companies. This is so there's a publication called Splash 24/7 that published an article called Why Investing in Dry Bulk Companies is a Bad Idea. And they talked about how a $10,000 investment had performed since the IPO of these companies. And you'll see in all cases, the investors in these companies lost money. But in our case, of course, a 10,000 baht investment in 1993 would be worth almost $1 million baht. So quite a different story. Some data on investor relations. Just a bit about our ESG activities. So in the year 2024, we're very proud to have received the Climate Action Leading Organization Award, the Thailand Greenhouse Gas Management Organization. We received this for the second year in a row. Also, for the second year in a row, we were awarded carbon neutral certification by Thailand Greenhouse Gas Management Organization. This is for offsetting our Scope 1 and Scope 2 emissions entirely. We also received a carbon footprint organization certification for our comprehensive carbon reporting practices. This is again for the second year in a row, actually. Again, just to highlight, we also, between the years 2013 and 17, as I mentioned in the previous slides, we replaced our fleets. We took delivery of what's called eco ships. This helped us reduce the average emissions per ton mile in our fleet from about 12.884 in the year 2014 to about 6.03 in 2024. We have voluntarily retrofitted energy-saving devices such as Mavis ducts, pre-chartered vanes, vortex absorb fins. In fact, in 2024, we also replaced the propellers for two of our ships, and this resulted in about 78% energy savings. Rather unusually for a dry bulk company, since 2009, we've had an environmental policy statement based on ISO 14001, 2004 standards, which was updated to 2015 standards. We're a founding member of the Getting to Zero Coalition. This is a 200+ company alliance advancing zero-emission vessels. And as I mentioned earlier, so we became the first Asian shipping company to issue sustainability-linked bonds, under which we have a target to reduce our emissions per ton mile by 38.4% in the year 2034 compared to a baseline year of 2019. So in terms of our social activities, so we continue to support the Michai Patana School in Buriram Province, to whom we're providing about 1 million baht each year. Since 1995, we've provided scholarships, a number of scholarships to students at the Merchant Marine Training Center. Most of these students actually join us, stay with us, they spend their careers with us. We hold an annual PSL, annual maritime day run. We reinstated that last year. Another thing to highlight. So last year, we funded the building of Bangkok's first canal cleaning boat, which we donated to BMA. This is to help intercept waste in narrow canals before it reaches the Chai Phraya River. In terms of governance, we achieved a AA ranking in SET ESG ratings 2024, and we were also part of the SET's Thailand Sustainability Investment List for the 4th consecutive year. We won Best Investor Relations Awards for companies with a market cap of between 10 and 30 billion in 2023, or rather for the year 2023. We've been adjudged as a company with excellent corporate governance for 15 consecutive years from 2010 to 2024 by the Thailand Institute of Directors and National Corporate Governance Committee. We've ranked in the top 12% of global listed transportation companies in S&P's Corporate Sustainability Assessment rankings. This is essentially an ESG ranking. And we've been certified as a member of Thailand's Private Sector Collective Action Coalition Against Corruption since August 2019. With that, we're open for questions.
So there are two questions already in. The first question, I'll read it out for you. What is your industry's view regarding the increasing fleet supply in 2025? What strategies could maintain the PSL competitiveness in the global market? I think we've already explained this, that forecasting in shipping is very, very difficult. Clarksons gets it wrong all the time. And what we see is that demand is going to grow in 2025, while supply will also grow in 2025, but supply will be reduced because of EEXI coming into play. Now, what we have seen is that on our fleet, where we had to apply what is known as an engine power limit, which we did, it reduced our speed on those ships from 14.1 knots per ship to 12.6 knots per ship. So when you see that reduction, it's 1.5 knots that has been reduced. Every 1 knot of speed reduced by the world fleet, and assuming only 250 sailing days, reduces the effective supply side by 5.5%. So therefore, if you're looking at a 1.5 knot reduction in our fleet, which is younger than the world average fleet, then you should know that the world average fleet will be slowing down more than 1.5 knots. And therefore, you could say that the supply side will be reduced in 2025 by about 7.5%. So it is quite significant. And we think that all these inefficiencies will allow us to fare reasonably well, as you can see, which has happened already in 2021, in 2022, in 2023, and in 2024. The second question is, what were the major customer industries? I think I've put up a slide for you, which shows you that we are focused much more in steel cargoes than in any other cargoes. We do not give out the names of the customers that we have, nor the volume of business that we do with them. And then the final question, which is there, what is your view about the handy-sized fleet in 2025? I noticed that the portion by deadweight tons of handy-sized fleets keeps increasing during 2024. Is it here any major strategic reason? No, I mean, the size of the fleet is only keeping in line with the amount of cargo growth that there is. As I've explained in the slides, the demand side is growing and the supply side is also growing. But remember, as I said, when you look at EEXI, it is reducing the world fleet by about 7.5% of capacity, just because ships are being forced to slow down by at least 1.5 knots, if not more, in their speed. Now we have another question again. What would be the optimal portion of revenue from both time charter and voyage charter? We focus mainly on time charter. We hardly have any business on voyage charter. So for us, we believe that time charter is a safer method. You're guaranteed a revenue per day. In voyage charter, there are no guarantees. And if the weather is good, if the loading is quick, the discharging is quick, you will get a better return than you expected. If on the other hand, if weather is bad and if there is delays at load port and discharge port, you will end up with a much lower per day return. So we'd rather not take that type of risk, and we would rather work with just time charter rates where we know what we're going to get.
ก็หมดคำถามที่ส่งเข้ามานะคะแล้วก็หมดเวลาของการนำเสนอข้อมูลของบริษัท Asia Shipping แล้วต้องขอบคุณทุกท่านที่เข้ามาร่วมรับฟังแล้วก็ส่งคำถามเข้ามานะคะขอบคุณค่ะสวัสดีค่ะ